Alright, we're getting through this. I realize there's a lot here, but I'm trying to just give you everything you need to be successful with the counterpunch trader. I think you're going to find the strategy is a lot easier than it looks. Maybe it doesn't need all these training videos, and I'm just trying to give you enough information to shorten your learning curve. In this next video, we're going to look at a variety of different subjects, okay? And we're going to jump around. Okay, let's just look at this to start this video. Let's assume that we're trading with this position here. This is the trade we're interested in on this particular moment. I want to talk to you about how we're going to trail. You've kind of seen how I've done it, but it's a real simple technique. When you're going long and you've hit that point where you want to start trailing, every bar that closes, you look at the jump line and you put your stop 2 pips below. And you could use trade tracking to do it. You can just put a horizontal line and do it yourself. And let's just do that now. So with every bar that closes, you look at your jump line. So the stop is going to go to 133.98. Then the next bar goes to here, and the jump line doesn't really move. It goes to 134.02, so maybe you're going to move your jump line to 133.99, right? Because you adjust 1 tick or 1 pip around the key level. Then it moves to here, and the jump line's moving up. Now the jump line's at 134.14, so 2 pips below that is going to be 134.12, and so you can move your stop up to 134.12. Like so. Now remember, the calculator won't start moving your stop until that second target is reached if you're tracking this, or if you've got other settings like I just showed you in the calculator training. Okay, but notice that the next bar, it jumps up again to 134.38. You can move this to 134.36, or if you work around the key level of 35, put it at 134.34. And so with each time it moves up, you're moving your stop up 2 pips below the jump line, plus or minus key levels. So what happens then right here, where you're at 134.78, you put your stop at 134.74, not at 76, we'll work around the 5, at 74, right? Then this is where it stabs down. But it goes to 743. So even though it looks like it stops out, it doesn't. It misses by a fraction, 3/10 of a pip, misses your stop. And because the bar closed below the jump line, we don't move the stop. Right here, the bar closes below. We don't move the stop. Here, we don't move the stop. Finally, on this bar, it moves above the jump line. And the jump line is at, not at 88, but at 89. If you think about what I just taught you in the last part of the calculator with the Forex rounding that extra digit. When it gets to, when it's only 2 ticks away, you go to the nearest one. So 88. So 2 pips below that is 86. Around the key level, 84. And this technique would have made an extra 10 pips based on this bar, the last bar to close above the jump line. So we didn't move it in here because these bars close below the jump line. You just leave the stop where it is. Then you got to close above the jump line. Now you can move your stop again. And of course, then it pushes down and stops out. You might adjust the stop below the bar if you want. That's certainly a discretionary decision. The point is that every time the bar closed above the jump line, you're moving your stop. On a short trade, it's every time the bar closes below the jump line, like here coming down, you move your stop. Now if I turn on trade tracking, track trade set to true, that's exactly what this is doing. It's trailing 2 pips below, but it's not making key level adjustments. And the reason why, I've got them all set to zeros here. So it is adjusting the extra digit, but it's not adjusting around the pips at the 5 and 50 levels because I've got these all set to zeros, you see? So I'm doing it manually. So even though it looks like this stop stops out at 76, I know that 75 is a key level. I'd push the stop down to 74 manually. We just saw how that kept us in the trade. because the price only went to 743, you see? And that enabled us to get an extra 10 pips when it moved up and closed above that bar there. Even though the calculator thinks it stopped out here. But it's because of how I've got the calculator set up. But that's how we use the trailer. And you could use that same technique if you want to use a slower jump line or a faster jump line. I showed you in the calculator training how you can do that. So while we're on the subject of key level adjustments, let's talk about key level adjustments. In most cases, a key level adjustment is on a 5 or a 0. So here we are with the euro yen. We have an entry at 133.88. To me, that's not a key level adjustment. 133.89, I might want to adjust it up to 133.91. But maybe because we have to add 2 to 3 pips of spread, we're not even going to adjust it at 133.89. Maybe we want to see it go to 133.893 or 894 and adjust it up to 133.90, and then because it's on a 90, we want to adjust it up 1 pip. So you have to kind of decide what's important for a key level adjustment. And with Forex, it's a little bit more nuanced because you have the extra digit and you have spread to consider. So it just depends on your trade plan and what trade plan you're trading. It's a lot easier to talk about key level adjustments when we're talking about futures. So let's look at this crude oil chart. Let's look at this last trade right here. The entry is at 50.85. And with most futures, crude oil, the Russell, the Dow Mini, basically any market that is not a quarter point tick market. A quarter point tick is like the ES or soybeans. If it's not a quarter point tick market, if you're on a 5 or a 0, that's typically a key level. Look at right here how the price stabbed down right at the 85 level. 5 is a 5. It's a multiple of 5, and it bounced right up. That's what you see at those key levels a lot. Look at these 3 bars here bouncing off of the 10, the 80 level. You just see it over and over again. And so we always want to adjust. If it gets to within 1 tick of that key level, we want to go 1 tick beyond it. So if you look at this trade is at 50.85, the entry. If the entry was at 50.86, 1 tick before it, or right on it, 50.85, we want to adjust it 1 tick lower to 50.84 and ask for a little extra confirmation. That's part of the whole confirmation principle. So if we want the calculator to do that for us, we have to turn on key level adjustments, you see, like that. And I've got all the default settings here. I already talked you through those. I don't need to worry about the extra Forex extra digit because this is futures, so that's set to false. I turned it to true, and now look, instead of the entry being on 85, the entry is now at 84. And the stop also, because the stop was, see the red dots here? The stop was at 51. That's a key level, a major key level. Now the stop moved above the dot to 51.01 because we turned on the key levels. You see? And if we look at it, you'll see that we got to within on the entry, it pushed it down, right? Because we got to within 1 tick of our multiple of 5 zone, and it pushed it 1 tick beyond, lower because it's short. And we got to within, we actually, the stop was right on a key level, so it was within 1 tick, right? And so it pushed the stop then 1 tick beyond, and that stop moved up to 51.01. And that's how those key levels work. Now, using key levels are very important. A lot of the trade plans, you just do that on every single entry and stop, especially with futures. Again, with Forex, it's a little more nuanced because you have the extra digit, you have to deal with spread, and so you have to assess, is it worth making a full 1 or 1.5 pip, maybe 2 pips after you account for that extra digit, 2 pip adjustment when you also have to add 1, 2, 3, 2 or 3 or more pips of spread. You see, on the bigger swing trades, it probably doesn't matter as much, but on the day trades, 2 pips, 3 pip adjustment ended up being a 5 pip difference off your entry after you put in your spread costs, that 5 pips could be a large percentage of your trade. And so you have to be judicious. That's why I always prefer to do the key level adjustments on Forex manually and not have the calculator do them for me. The only thing I want the calculator to do for me is that extra rounding of that additional digit like I showed you in the calculator training. Now there's another type of key level adjustment that's more discretionary and it's not programmed into the calculator, and that's when you make a chart level adjustment. So right here, by coincidence, the chart came down and gave us a little near-term support and resistance level, and that was on the key level of 85. And maybe it was 84. Let's just say it's 84, okay? And then we get this entry here to go short at 84. I'm going to make a discretionary decision to push this one stop lower to 83 and try to get through the support, right? That's if this was at 84. We're just assuming it is for the sake of the example. All right, let's use this example. Let's say, for example, you're coming into the market, you want to take this short trade, and you see that it's already triggered in. Okay, the entry's at 5104. It came down, it touched 5104. You're coming in, and you're like, well, if it comes back down again, I want to take that trade. Do you take it at 5104? Or does it make sense to make a one-tick adjustment down to 5103 and ask it to push through this new established low, which might be a support level? That's a chart level adjustment, and I'm going to do that every time. So the rule of thumb when you're making discretionary adjustments to try to get extra confirmation through support and resistance levels is that you can make 1 or 2 tick adjustments anytime, 3 ticks sometimes, you have to have a good reason, and 4 ticks rarely, and you could even make a 5 or 6 tick adjustment on a really big trade if you have a real compelling reason. Maybe you're trading into the low of the day, maybe you've just got this support level that just doesn't want to break and you don't want to get short into that level, 5 ticks on top of it. Maybe you want to adjust down around the next key level and really make it push through. Maybe it's a big trade and it's only, even 5 ticks might only be a 10 or 12% adjustment. You have to make those decisions. For the most part, you're not going to have to make big adjustments, and you shouldn't. It's a bad habit to get into. But every now and then it's just glaring at you, okay? You also can't be perfect. It'll never happen. Sometimes you'll make those adjustments, it'll go through, you'll get triggered in. You'll pay extra because you made an adjustment. So you have more risk, less profit, and then it turns around and goes against you and stops you out anyway. That can happen too, and that's why it's important to just make small adjustments most of the time. 1 or 2 ticks are okay. 3 ticks sometimes, 4 times rarely, anything more than that, even more rarely. Think like a chess player. You should have multiple reasons to make those big adjustments. Okay? You might want to make a 1 or 2 tick adjustment around one of the EMAs, for example. What about a stop and reverse? On a stop and reverse, there's a couple ways to look at it. First of all, if you're in a trade and it's already made a profit, like in this one, hit first target, you've already got 1 tick locked in. It's going to come down and stop out, or it's going to get through the jump line and stop you out, and then you get a short trade. There's no stop and reverse in that case. But what if, for example, you're in this white trade here, and it only goes a little ways, and then you get a stop and reverse to short right here? Do you go short? I mean, you got to use your tools. You can use your SMA and say you're only going to go short here if it's down. You can make sure that you have the signal line on the histogram crossing over to down. Here you can see that the move up is still strong because you've got a spread between the 2 signal lines. And it looks like it's moving up. I mean, yeah, maybe it's starting to flatten out a little here, but you don't have confirmation on your histogram. Sometimes it'll move too fast before the confirmation happens, but quite often that's telling you you want to stay with the long trade. Now, if you did stop and reverse to short in this case, then you're cutting your risk from here to here, right? That's how much you end up risking and losing, instead of from here all the way down to here. And then it pushes down and it actually goes through its target. Now, of course, this is a pretty small trade, maybe too small, so it might not be the best example, but this trade could be bigger. The same thing could happen. So one of the things I like to do is protect my long position, and if my entry is at 51.12, I might move it down 2 ticks to 51.10, and then 1 tick adjustment to 51.09. And a lot of times that's enough to keep me in the long trade. And if it stops and reverses, I'm still honoring the short trade, cutting my risk on a losing long trade, and able to get on a trade that has a good chance of success. So you can combine all those different tools to try to not stop and reverse. Sometimes you just can't help it, and you just have to stop and reverse. If you got long, for example, on this bar, and it comes up, it doesn't quite hit target 1. Maybe it didn't get close enough to move in and lock in a tick. Maybe it did. Maybe you're in on that trade. Whatever trade. One of these trades doesn't go far enough, and now you have a stop and reverse to go short here on a counterpunch. Well, the counterpunch, you already know that you have histogram confirmation. You already have the signal lines crossing. Notice if you got long here, you're only risking the distance between your two entries instead of all the way down to there. So you cut your risk. You might add or subtract a few more ticks from that entry for extra confirmation. And it's going to trigger in anyway. Okay, but you're still cutting your risk on a losing long trade. And then it comes down and at least hits your first target if we're coming up and stopping out up in here. And then it comes down all the way down again, you see? And you're able to pick up here. Now, a lot depends on if you're using the SMA and the trending method. Because if you're using the trending method, you can't stop and reverse here because the SMA is up. And so you're going to stay with that long trade. The only thing I would say is, and you're near the apex, right? The apex, the crossover is just kind of getting underway. So maybe it comes down, finds support, and starts zooming higher. You just don't know what's going to happen. But usually when the market spreads further and further away from these moving averages, there's a good chance it wants to get back down to that 50 EMA. And you can see it's more than 100% above the difference between the two, the 50 and the 200, right? So those are all clues that this market could go down. It's already come up a lot, and you've had 1, 2, 3, 4 long trades in a row. At some point, it's got to come back down. You got to put things in context. You're not always going to know, and you're not always going to be 100% correct, but you do want to make small adjustments and ask for a little extra confirmation before going short. Whether it is you need the histogram, whether it is you're asking for a couple more ticks, or both, or you want the blue line confirmation. And the blue line confirmation, this doesn't really happen until this next bar here, when the blue line goes from 51.99. Yeah, it doesn't even move still because there's only 2 digits. On some markets, it's more sensitive. So, and it's already pushed down to target 1 anyway at that point. So if you're using the trending method, you're probably stuck in that trade, and you're going to end up with a full stop out. And then you just get the next trade, which is quite a bit larger, and that hits, misses that big target barely. And so you make it up on the next trade. You just have to stay with things. Even the next trades after that work out. You just have to have faith that this is going to give you the winning trades. You just can't worry about a trade that loses. But what you do need to know is the small adjustments that you make, whether you're stop and reversing, whether you're trying to get around a support and resistance level on your chart. Those little adjustments make a big difference. With crude oil, I'm typically wanting to stop and reverse. I ask for a little extra confirmation. Most of the time that prevents me from wiggling into the wrong side of the trade. Every now and then the idea isn't going to work. Sometimes no matter what you do, it's going to be wrong. It's just going to be a losing session. It happens sometimes. It's rare. You're going to get a lot of winning sessions and every now and then a losing session. This is part of trading. The thing you don't want to do is continually mix up your method. One day it works, one day, one trade it doesn't work, you start changing stuff. And then the next trade you wish you didn't change it. Because nothing's going to work 100% of the time. You just want to stick with a method that works most of the time, and then you let the odds work in your favor and grow your equity like that. When we talk about trade plans and stuff, we'll discuss possibilities on what you can do. And what I've found is that whatever method you decide, it typically works. So you might not want to use the EMA at all. Just take it off your chart. You don't want it. On some charts, you might want to use it no matter what. So you turn it back on, and all your trades have to agree with the SMA, or only your stop and reversals. If you get a strong trend like this, you see that it failed going up and now it's heading the other direction, and you get a heads up with the 20 SMA turning, the 50 SMA giving you your elbow, your squeeze zone. Short trades, those are going to work a lot better. It's coming down at a steep angle, crosses over there, crosses over the 200 there, and now you've got it fanning further away. You got the 50 fanning away from the 200, you got the faster 20 SMA parallel and slightly spreading and fanning away. You're all in the red, so you know you've got a strong downtrend. The signal line isn't going to help you to the long side. You got to be careful of counterpunch trades moving up into the accelerating trend down. And you can see it from what the lines are doing, and now the price action also following. I'm not going to really want to take these long trades. When I'm in a strong trend, that's where the 20 SMA really helps you, because it gives you a heads up when it might be weakening and as it's strengthening. I mean, even all these short trades all the way down, even that one hit the target right on the nail. See, target 1 right on the nail, this one. And the smaller one, target 1, target 2, target 3 right on the nail also. The purple one. That one just missed triggering in, which was good because it came up, found resistance. Action, reaction, subsequent action. That's what we're trying to do. Market exhaustion points. Right? You had a market exhaustion coming down. Are we attacking going up? There's too much against this long trade. If the blue line had begun to turn, obviously it didn't trigger in any way. Maybe I adjust my entry above that apex to there. So instead of 66, maybe I make an argument that that's a 5-tick adjustment on a pretty good sized trade. Push that up to 71, for example. If it's going to go through, it's going to go through. You got a lot of resistance. You don't want to get long right at that apex. This is coming down, you see. Even from here, you could even see that. It could push up and go higher, but let me ask for extra confirmation and put my entry a little higher. Let it prove itself to me. Stay with that trend if you can. All right, so you're going to see these patterns over and over again, and you're going to learn from them. The more you see them, the better you're going to get at it. Another thing I noticed is how you can use the chop part of the HTC indicator. Sometimes you just get 2 or 3 bars in chop, right? Green, red, red, green. And what I've noticed is you can use the green coming out of that little zone there. It almost acts like jet propulsion. Like, look at this long trade right here. You can see that there's an elbow and it's coming up. You're following the 50 EMA up. You got the 20 SMA even showing you that it could be moving even faster up. You're not going to want to go short against the 50 EMA right here and here, even though it never triggers in, luckily. But even if it did, you're approaching the squeeze zone. You got your elbow. You're coming up. It's trying to get to that apex. You're in the squeeze zone. You don't want to go short against the 50 EMA. And you get this long trade here. Notice that none of these bars close below the jump line. So that stays good. That trade never cancels. And if you turn trade tracking on, you'll see the plus, 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 plus go all the way across. So that trade's still good. And do you want to go from 50.64 up to 50.61 and get above that swing level? Well, it'd have to be a very large trade to substantiate a 7-tick adjustment. So for me, no, I don't want to do that. I've got enough information. I've got all these lines going up, and I've got a failed swing level trade. I don't need to make a 7-tick adjustment. That's going to mess everything up, because then where do I move my stop when I hit money management? What if it guts through and then goes down the other way anyway? That could always happen. I'm just going to take that trade at 50, 56. I'm not going to go all the way up to 61. And actually, it's only a 5-tick adjustment, but it's still too much because the reward on the trade just isn't big enough. A little bit. If you turn trade tracking on, you'll see why, but now you can see the reward on the green trade. And it's just not big enough. You know, these targets are too small to make any kind of adjustment on it. But notice that when it hits the green dot, it gets into a little bit of chop here, and then we get the propulsion out of the chop, which hits our entry, and we're lucky because look at how it just gives the move up a burst, a power burst. Because the Bollinger Band moved into the Keltner, you had that tightening, the compression, and then it moved out again, and it's like a release of the compression. And so you get this nice move here. And you could see that here. You'll see this more and more now that you know what to look for. The signal line also crossed up and over. A lot of good things going in your advantage on a trade like that. Okay? You can't be afraid of every single swing level. That's why you keep those adjustments very small. Here's another thing you can look for. This is an interesting chart. This is a ETF on United States oil. Okay, it's a daily chart. Yeah, you can trade stocks and ETFs and do very well with counterpunch. And you'll notice that these patterns look the same as if it were any chart. We just kind of looked at something similar on crude oil. Okay, you got your elbow down, you're in the squeeze zone. Probably don't want to go long against the declining EMA. Okay, maybe you don't know it yet at this point. Either way, once you're in this zone here, it's the short trade following the EMA. That's going to be good, right? We already know what happens, but you've got a clue, and you could put the 20 SMA on. Okay, and as it keeps coming down, at some point it's going to come up and test and touch that 50 EMA, and it does right around in here, and again up in here. When you are coming from it down to above like this and you touch that 50 EMA and then you get a set of exhaustion dots right on the 50 EMA like this, usually the short trade that follows is going to be very powerful. Okay, you're in chop here, so you're not taking any of these long trades up into the 50 EMA anyway because the chop zone prevents that. But when you see the dots lining up in the direction of your yellow brick road, the trades that go in that direction tend to be really good. So you could look at a lot of markets and you'll notice if you're following a prevailing trend that your group of dots is going to start forming on that 50 EMA, maybe more than in one place. And it could be just close, it doesn't have to be right on it. A little above, a little below. Those set up really strong trades. So watch for those. You could learn to specialize. You could put a faster EMA on, or you could use your 20 SMA for a similar principle. Here's your 20 SMA. Right? You're in a pretty deep trend. The market can't quite get up to it, but some of these dots are at or near it, usually set up good shorts. There's one right on it. You see, this one's near it, this one's on it. Really nice shorts. Couldn't have got that because it gapped through, but you get the idea. Of course, we know that oil's been going down, down, down. Now we're in a possible long trade. Now we're in a possible stop and reverse. When I am in a long trade and I get this possible purple stop and reverse, you know, you got to anticipate that the price is going to want to come down and test the low again because you have no test of the low. And it wasn't able to quite get to the 50. It still can go up, but now you're kind of, you know, I wouldn't be surprised if it enters a chop zone. Do you get short here, or do you make a little adjustment and try to protect your long trade before getting short? You have to know what you're going to do. You should have a trade plan that tells you what to do. and then you could test for it, and if it works most of the time, voila, you have your answer. For me, the SMA is up, but it could turn, it could come down and test. I'm going to make a small adjustment, probably below the low of this green bar, and if that triggers in, I would stop and reverse. Maybe I'll go close, to hit one of these small targets. And let's face it, if you get long right here and you stop and reverse right here, it's very little risk, small loss. But that's how I would handle that.